Good morning, everybody. My name is Chad Lynch. Thank you for joining us this morning. I'm the Director of Corporate Business Development at Orrick. Thank you for coming to our latest Total Access panel. Obviously, the topic seems to be fairly timely. A couple things. If you have anything that makes noise, please turn it off. And there's one piece of paper in your handout which is very important to me, and that's the feedback form. All the panel topics that we do come from the market. So if you have to leave early, please take a few minutes to fill that out for us. Total Access, very simply, is an educational platform that Orrick's developed and utilized for 4 years. It's been hugely successful, not always this successful. And the tagline for the program is today's tools for tomorrow's success. So we try to focus on tactical topics which help entrepreneurs build successful companies. As a follow-on to this discussion, in June, we will be having a discussion about incubators. With Dale Resi and Dave McClure have been confirmed so far. We probably don't need anybody other than Dave on the panel. Yeah, okay. But that'll be on the 21st of June, so please put that on your calendar. And then as a follow-up to this, we will be doing some term sheet, convertible note, smaller sessions. If you're in that process of getting ready to negotiate, it would be very helpful for you. We'll do it in the city as well as Menlo Park. We will also send a copy of the video to you when it's late afternoon, probably. So I'm going to turn it over to Larry Kane, who's a corporate partner at Orrick, and he's going to introduce his panel. Thanks very much for everybody for coming today.
Thank you, Chad. Can people hear me? Yes. Great. I really appreciate everybody coming this morning. It's a wonderful morning. It's not raining. We're going to try to get right into the panel and start the presentation. I'm going to ask the panelists to introduce themselves. We're going to just go right down the way. So Jeff Clavier, founder and managing partner of SoftTech.
So it took me an hour and 10 minutes to come up from Palo Alto, so I'm not sure whether we're in a recession, but certainly traffic isn't. Apologies for being late. SoftTech VC is a micro VC firm. We've been investing for the past 7 years in consumer internet. We have closed to date 103 deals, about to close 104, 105. We're focused really on the very early stage side of the house, so we're always part of the first money in. We invest $250,000 up to $750,000 in the first round of companies, mostly in Silicon Valley. We consider that New York is a suburb of Silicon Valley, so we're very comfortable investing there now. 15% of the portfolio is in New York, and we're pretty excited about all the developments happening today around the cloud and mobile.
Jared Hansen from Breezy.
So I'm the founder and CEO of Breezy. We're a mobile printing company, a cloud-based mobile printing company, so that works out well. We make software that makes it really easy to print or fax anything from any mobile device to any printer or fax machine. We've got applications for the different mobile platforms as well as an API that allows other developers to leverage our print infrastructure to provide printing support through their apps. And we are, people can print to their own printers, to their company's printers, or to a partner network that we're building of places like hotels and airports and conference centers and so on, that will let people print, using geolocation on their phones to find the printer closest to them. So we recently closed our seed round of funding from a great group of investors, including Jeff, and that's who we are.
Rob Hayes, managing partner of First Round.
Hi, Rob Hayes with First Round Capital. So we're a seed capital fund, and we've been doing it since before it was cool. So about 7 years ago, we've got a national footprint, invest all across the country, but not so much outside of the country. Offices here in San Francisco, in New York, and in Philadelphia. Our model is really to get in. We want to be the first institutional round of capital, and so sometimes it will be a little angel round that will be done before. And sometimes we're part of that angel round. We like to get engaged with the companies and really help out in the early days of the company. And I've also developed a pretty substantial platform, a set of tools and support that we have for our portfolio. So once you're in, there's a whole set of things that you get access to. So that's us.
Mitch Kapor.
Hi, Mitch Kapor. Serial entrepreneur back in the Paleolithic era. I founded a company called Lotus. People over 35 have probably heard of Lotus 123. The rest of you can look it up in Wikipedia. I've been doing angel investing actually for a long time, and I'm proud to say I was the first investor in some of the major companies that have helped make the world the way it is. In UUNet, one of the first commercial ISPs in Real Networks, which was the first successful streaming media company, the founding chair of Mozilla Foundation, the founding investor in Linden Lab, which makes Second Life. Kapor Capital, which is the moniker we're operating under, is on the borderline between being angel investing in a micro VC fund, because it's funds from my trust and foundation, but I have a partner, Stephen DeBerry, and we've been quite active. 50 investments in the last 2 years, all seed, $100,000 to $250,000, typically in 2 categories: generalized, new, disruptive technology platforms. So we were one of the first investors in Twilio. We were one of the first investors in Uber. And increasingly, we're looking to invest in great seed stage IT companies that also have a positive social impact. So I'd cite a company you haven't heard of yet, but hopefully you will have heard of it in not too long, called University Now, which is going to be an online institution, accredited institution, university degrees, all online, disruptive, high quality, low cost. So,
Naval?
Yeah, is this thing working? Great. Naval Ravikant was an entrepreneur, started a couple of companies, ePinions and Vast, and then I was co-authoring Venture Hacks, and now I'm the founder and maintainer, co-maintainer of AngelList, and I work day and night on it. It's my baby.
Okay, great. So, state of the environment. What do you guys see as the state of angel investing, and what are you guys interested in right now? What's hot? And we'll go back this way. Naval.
Yeah, the state of the market changes very, very fast. I get a little bit of a bird's eye view thanks to AngelList. And I would say that in the last 6 months, the angel activity from sophisticated investors has definitely pulled back. A lot of the money that's coming in the marketplace right now is either coming from the venture side or is coming from less traditional angel investors. I also think that there are memes that kind of rise and crash very quickly. So, middle of last year, Groupon clones were hot. Today, good luck getting one funded. But there are even smaller mini memes that rise and crash, like mobile loyalty QR code platforms, or there's like a bunch of deal aggregators. So it's just kind of interesting to watch sort of these waves come and go. I think the bar has also gotten a lot higher for raising money because you can do so much more before you raise money these days. So 2 years ago, you could raise money with a good team and a concept. A year ago, if you were doing anything in mobile or web, you probably needed a prototype. Now you probably need to have launched it and get a little bit of traction or some adoption proof. So the bar sort of keeps getting higher as all this leverage in the system makes it more competitive for all the entrepreneurs. So those are some of the trends that I'm seeing. In terms of what's hot, I think having something unique that's hard to do and is interesting is always the hot thing. So I wouldn't try and bet on any sector, because by the time you figure it out, it'll have peaked and crashed.
Mitch?
people should just listen to what Naval has to say, because he's right about each and every one of those points. The only thing I would add is I'm going to utter the B word. We are in a bubble now. I lived through the 1999 bubble, and I think for entrepreneurs trying to start companies, how you act in a bubble environment, you have to take that into account. There's sort of far too many people trying to start companies that can actually get funded, but paradoxically, there's also far too much money out there trying to find companies to fund, and what typically happens when those intersect is a very large number of companies get started with an extraordinarily high failure rate because of those two things coming together. Unsophisticated money funding things that probably shouldn't get funded because the spaces are too crowded at valuations that are too high. So what I hope we'll talk about during the panel, and I'll certainly come back to it, is given all those givens, let's assume that you are the one entrepreneur in 50 who is going to surmount this. What strategies do you use?
Rob?
The indicator that I can point to is the fact that you had to move this event to a larger room, and still not everybody has a seat, right? So this is phenomenal. How many people are here? I think that the trends, like Naval says, they come and go, and anything that anybody's, like once somebody is writing about something as a trend, that means it's too late to actually do anything about it. The thing the trend that I will point out that I think is really, really interesting and I think great today is just the tremendous amount of transparency in the environment, but in the funding environment in terms of people that are starting companies, people that want to invest in companies, and things like AngelList and other platforms that people are creating to make sure that there is a real marketplace for those people to meet. And I think when the floodgates on those things open, crazy things can happen, but as they mediate, I think that it's going to be a better environment for everybody.
Jared, since you're not investing, maybe we'll flip the question a little bit to you. Tell us a little bit about your fundraising process of how that triggered, and I know it took a while to get there, but then it came quick.
Yeah, it certainly was a long process coming together, and then once it did, as you say, it was very fast once the ball started rolling. I think it goes back to what Naval said about the bar being higher in terms of what you have to do before you're in a fundable position. We had actually launched our initial sort of 1.0 application in the BlackBerry App Store last May, and had, by the time I went out to even start thinking about raising money, it was, I think, 6 or 7 months later, and we had several months of, month over month, steadily doubling user growth. So we had launched product, we had traction, there was a pretty clear market demand, people were paying money, and even so, when I first went out to have some fundraising discussions in the fall, after coming off of a couple of big demos and awards and things like that, it was very difficult to get any kind of any interest. It didn't go very far. And it was only after another few months later when we got a great lead investor involved, Excel Partners came in, but that wasn't until like January, and we had just continued to show additional traction and release on new platforms. And so I think from our perspective, though I can't comment on obviously trends in the market, there is certainly, I would certainly make a recommendation that before even trying to talk to people, you'd have something out there, some product that people can use, some product preferably that people have been using and preferably paying for a little while.
Jeff, back to the original. Jeff, back to the original question.
So I agree with everything my friends have said. We've taken an approach so there was a time 3.5 years ago when I started SoftTech as an institutional firm that 20 deals a year was like crazy. And now we're only doing 20 deals a year because some of our peers, and I'm not saying that we're right and they're wrong, we just have a different strategy. We only do 20 deals a year, and we're like now almost a laggard in terms of the velocity of the things that we do. And out of the 200 or 300 deals we see qualified a month, we're going to meet maybe 20 to 30 people, and we're going to do 2 deals. And we've now taken this sort of mental approach saying, hey, every day there is a new deal that comes and is interesting, and we can really sort of try and figure out what is differentiated, what has value, what is actually building a business, and try and stay away as much as possible from trends and celebrity deals. Because at the end of the day, I don't do those anymore. This sort of hot piece of startup is a good example of what we like seeing. Jared had 2 things sort of against him. One is a solo founder. It's actually hard to be a solo founder, so it means that you need to be even more impressive. And is a former lawyer. Just joking. And the point is, it hurts. The point is that Jared had to show a lot of traction, a lot of market demand, a lot of proof points in a market which isn't as obvious as you would think. But when you dig in and you do your due diligence, you figure out this is actually a really big issue with a really big potential. And that's why, at the end of the day, we decided to back him. And for us, it's at the intersection of cloud-based services and mobile. And the mobile services economy is something that we're extremely excited about, which is enabled by those, hundreds of millions of smartphones that are sort of floating around right now. But it doesn't mean that just because you have a cool, app, you can actually get funded. I think that the time where just the app was getting you sort of the excitement from VCs is sort of gone, because what we understand is if you just have that, the monetization is just really, really challenging. Having that as the front end of your service with a really powerful back end, like what Jared has built, I think is really sort of interesting.
Switching from the market, people can hear me, let's talk a little bit about the process of an entrepreneur in the fundraising process, and how do they get to you? What are you looking for in the pitch? And also, how much money should they be looking to raise on their seed angel round financing? And we'll start with you, Mitch. What would you encourage our entrepreneurs here to find the super angels in that process?
Yeah, I would underscore a couple of things that have already been said and become much more specific. So the first thing is the bar is set a lot higher, meaning things that we invest in, and we're almost always in the very first set of money a company is raising, other than maybe a little bit from friends and family. We pretty much expect to see something that actually works. And even better, if it's something that charges money, we expect to see a little bit of revenue. And that's because you can actually, on very small amounts of money, I mean, virtually none, if you just have some time, you can get your concept to the point where you can demonstrate what it's actually doing. And so projects that don't do that are just at an enormous relative disadvantage, because if you can see the thing actually working, not complete, obviously, what is sometimes called a minimum viable product, the first instance of it, you can assess what the risk is. Is this something interesting? Do these people know what they're doing? What are the chances that they're going to succeed with it? And so I say that's the first thing. The things are, and Naval said this, and I want to unpack it and underscore it. When I say I'm just organizing a team of people, and here's my concept, and God forbid it's another Groupon clone, but or something trendy, it's of very little interest. And it's a kind of, this is the other point that I would make, a probability game. I think we all get, I don't know, 5, 10, 20 times as many pitches as we could possibly even take and sit down with people. It's just the nature of it, and maybe it's 50, I don't know, it depends on, but it's a huge number, and that means that even something that is worthwhile, if there isn't some proof of it, whether it's social proof because it's introduced to you by somebody that you trust, or the kind of proof that comes from it being on AngelList and hearing what other people whom you know have thought of it, it's very difficult even to take a pitch. And I do that knowing that I'm winding up not even being willing to take a meeting with some things that are worthwhile, but you just cannot possibly see everybody. So the burden gets pushed back to the entrepreneurs to demonstrate by have something up and running so I can click on a URL and get a quick sense of it, or to get some kind of working social proof. And then take a meeting. And I think I won't answer the rest of this because I've gone on for too long, and other people here can answer the other parts of your question.
Rob?
So it was a couple years ago now that we had a little tiny event in my office. I probably could have fit the first 2 rows of people here. And Jeff was there. And it was an evening event. And so instead of drinking juice, we were drinking, what was Jeff? So wine. And, and someone asked a very similar question. After 3/4 of a glass of wine, I was just lubed enough to say, well, I guess I look for 2 things. I look for kick-ass entrepreneurs in big-ass markets. And then in this moment of irrational brilliance, I said, I guess I look for 2 asses. But that is really what I look for. I mean, and so we got something like 700 different investment opportunities that came through our office last quarter. And we have to have a way to narrow those down into something that is manageable, even for a group of four partners. And so the first thing we look for is what is the team and who is the team? Are they people that have done it before? And if they aren't people that have done it before, how do we learn about them and what do we know about them? And then how is the team structured in terms of I met with a company a couple of days ago where they had a CEO, a COO, a CFO, a VP of marketing, a VP of sales, and 2 engineers. And I'm like, well, who's going to do the work? And so it's that sort of thing. And then we look obviously for big markets because I will disagree a little bit with Mitch in that I agree with Mitch in that I love to see a product and I love to see that people can build a product. But I also know that the product that I'm looking at is never going to be the product that ends up winning, right? And so what I'm looking for is a team that it's moving in a big enough market and has the ability to take whatever they've started with and turn it into something just freaking massive. And so those are why those are the 2 things. And it pains me as an ex-product guy to say that it's, oh my God, I've got my glasses. It pains me as an ex-product guy to say that because I do love products. But really for me, having spent enough time and falling in love with products and making a lot of bad investments because of that, that is what really drives me.
Just for the sense of the audience, you had 700 opportunities last quarter. How many did you invest in? Or will you invest, maybe?
Last quarter, we invested in, I want to say about 12.
So 12 out of 700, and the size of the investments ranged from?
Our average investment size ranges, so 95% of the investments, the initial investments we do are between, call it 250,000 and 850,000, but there are significant outliers on either side.
Jeff?
So when Rob said that, very sort of profound, I said, yeah, but you know what? Having had more wine than you had and being French, I'm actually looking for 3 asses. And it's really the smart-ass team, the big-ass market, and the kick-ass product. Because the issue, I completely agree with Rob that most often the product you see first is not what you end up really scaling and being successful upon. The problem is that even a great team in a potential market can come up with a pretty shitty product if you just go and say, hey, just trust us. And so I have really a hard time, and it's one of our sort of filters to just essentially give a pass to the team on the product side. So I want to see something, or I want to understand that you're going to build something which is going to be interesting, differentiated, and you have sort of already figured out a few things like customer acquisition, customer retention, customer referral, which will sort of give you a way to acquire your users, keep them around, and hopefully figure out a way to push them to help you acquire more users. And we're struggling with that, to be honest, because sometimes we pass on great teams that do interesting things just because, they don't really know exactly how the product's going to end up looking like. And 9 months later, we go, damn, we should have invested. But, in the law of large numbers of deals that we see, we have to put some filters. And we know that we won't do more than 2 deals a month.
So let me argue with you, French.
Please.
My mic's going on and off?
Yeah, just wait for it to shut up.
I agree. If you come with a shitty product, that's not gonna endear you to me, right? Especially as an ex-product guy. But if you come with an unfinished product or a product, so like Aaron Patzer is the perfect example. When I met Aaron from Mint, he had essentially a more or less a wireframe demo of what he was doing and something that was clearly imperfect. But the guy was astonishingly amazing, and he was going after a massive market. And so sometimes when you're early, you don't get a chance to see. Now, if someone has a completely finished product and they say this is it, and you look at it and you kind of cock your head and go, well, but this sucks. I mean, that's that's not going to help, right? But often in the early stages, you don't have, you don't have enough of a product there to make a decision on the product. That was my point.
So I met Aaron 2 days later and actually agreed to invest as well. So I won't disagree with Rob. I think it's a fine balance between the promise of the product and what has already been built, but the product component and differentiation is something that we sort of look at. In the case of Aaron, there was sort of the personal finance side that doesn't exist, but everyone wants in the US. And I fell for that. Thank God.
Naval?
Yeah, I'm not sure I'm actually answering any question, but I would say that if you're sitting in this audience and you're going to start a company, and that is the meme du jour, you should really reconsider. You shouldn't do a company unless you're irrationally passionate about it, because it's a very, very efficient market out there for starting companies. It's gotten very easy to do one. I mean, I think Y Combinator is cranking out 61 in this batch, and there's dozens of those combinators. So every idea you can come up with is being tried. It's every monkey with every keyboard is out there trying to recreate the next whatever. And so you don't want to get into something unless you're so irrationally passionate about it that you'll stick with it to the bitter end. Because we're in an up fundraising cycle, which means you can raise money, but then that's a prison that traps you for the next 5 years or more in obligations to your investors and the people you recruit. So only get into it if you're willing to see it through the bust and then to the next bubble, which could be 3, 5, 10 years out. So I would just say, just be very careful about what you're getting into. Personally, I've started 7 companies now, and I'll only admit to 2 or 3. And until I did AngelList, I would say I was never truly irrationally passionate about it. But AngelList, I kind of feel like the suicide bomber in the room. No one's going to stop me. I'll be doing it until the day I die. And it's because I love it. And so you have to feel the same way about what you're doing. Otherwise, you may not make it to the next upcycle.
May I annotate that?
Please.
I want to annotate that, which is irrationally passionate, I would say, is terrific, is necessary, but not sufficient.
Clearly.
Because
right.
my pet peeve is irrationally passionate entrepreneurs with terrible ideas. Yeah. It's not a substitute. And so I'm also a product guy. And people who are irrationally passionate are the ones who just try to argue you down in each and every instance, and not actually listen and take feedback. And that's something that I actually think is important for entrepreneurs' learning curves. And I think all of us here actually, while we're in business to make money, we actually love entrepreneurs and love helping. And sometimes you come in and you pitch and you get turned down, but you can actually take away something of even more value than a check, which is a point of view or a perspective on what you might want to consider doing next to make the thing more fundable. And one of the pet peeves is sometimes people are so much in sell mode that absolutely nothing gets through. And I always feel sad and like it's a lost opportunity. Like, no, I'm not going to invest in this thing, but I actually have something of value, a gift that I'm trying to offer, and it's being spurned. Now, you're not supposed to take care of my feelings. I'm a big boy. But the point is that not just me, but with experienced investors who are also entrepreneurs and founders, there are many different dimensions of value that are exchanged in meetings. Please don't be so focused just on the check that you miss the other things.
Yeah, if I could just add 1 or 2 quick things on top of that. One thing I haven't heard anyone mention here yet is I think it's important to do something that's hard, something that's difficult. I personally love that. When I see something unique, differentiated, difficult, and my first reaction is, wow, that's possible? And then I see some product implementation that makes me realize, like, yes, this team has some expertise in this space, and this might actually be possible. So if you're looking to stand out in this market, and you have that characteristic, I think that helps a lot. I also take a slightly different point of view with, I think one of the questions is, how do you go about raising your seed round? What are the tricks in the process? The tricks in the process are out there. That's not the hard part. If you have a fundable company for the environment, you will get funded. But if you find you're not getting funded, to Mitch's point, you should not go out there and just sell harder. That's not the solution. You should do what Jared did, which is put your nose back to the grindstone, make more progress, and then you'll find it all comes together all too quickly. Pounding the pavement, meeting with more investors, getting more turndowns, arguing with them more, selling them more. That is not the way to do it. Just focus on your product, focus on your team, and when it gets to a certain inflection point, you'll find too much money will show up.
So what's the value of incubators, Founders Institute, Y Combinator,
Obviously, they've got a great reputation. Founders Institute, in my case, was really, really useful. Different people, I think, have had different experiences or would have different things to say about it depending on who you ask. But overwhelmingly, I think you get out of it what you put into it. And I think the biggest value for Breezy and for me was to just the contact that we got with the mentors that they brought in, the ability to sit down with people like Aaron Patzer from Mint or Phil Libin from Evernote and just have a conversation about how to build an awesome product and how to get serious user adoption and so on. It was a really valuable experience. I think the process of stepping through, in Founder Institute's case, there are sort of different modules that you go through. I think each week in the summer or in the semester that you're in, they bring in experts on one particular aspect of growing your company. So there are some sessions on hiring and firing, there's some sessions on branding, there's some sessions on legal and IP protection and all these sorts of things. And even though having had a prior background in law and in business, there were lots and lots of gaps. And so being able to have that structure and go through and get kind of a coherent view was really useful. Some people have looked to incubators to provide introductions to investors and stuff like that. I don't think it's a great value for that, but I think it's a great way to network with smart people, particularly if you choose a good incubator. But a great way to network with smart people who have already successfully done what you're trying to do.
Jeff, any thoughts about
I think
the value of the...
So there's a couple of things. One is you mentioned YC and DocPatch. So DocPatch is really sort of the co-working environment, and that the tremendous value of those places where you have a bunch of really interesting startups sort of hanging out together is that you can actually share, exchange, get this sort of cross-fertilization between teams where some people might be just more experts about customer acquisitions and some others would be sort of better at design, and you can really get that benefit by sitting next to people and sort of hanging out at the coffee machine, which is really valuable. So when you start, as opposed to sort of staying in your bedroom or whatever, hanging out at one of the co-working places might definitely be a good option. Then there is the whole raft of incubators which have popped up over the country and now the world. And I would say that for the most established, Y Combinator, Techstars, Seedcamp, what you get is essentially a process where they see so many applicants that whoever makes it, the 10, 12, 40, 50, 60 companies that end up in the program are just some of the most interesting entrepreneurs and ideas according to the people running the program that they could actually get on board. And that means, typically pretty good quality. Doesn't mean that if you get, accepted, you will get funded. I think there's a pretty good ratio. I was with the FTH who runs Techstars New York, and he told me that 9 of the 11 companies of the program of the winter got funded, and a couple were actually doing a pretty substantial round. So the fact that you go through that process, that you're exposed to mentors, that tacitly you will sort of get easier access to capital and advice is actually of great value. We've done a bunch of those companies, and I would say it's too early to say whether there is a higher return involved in those sort of graduates, but we'll see over time.
Mitch, your thoughts?
Yeah, not all of these incubators and accelerators are created equal. I mean, even among the ones that are more than co-working spaces, sort of what they offer, it's kind of like picking a college to go to. Part of the appeal is if you get into Y Combinator, it's like getting into Harvard. It's like a ticket, it signals stuff, and it has a lot of value. But at the same time, I will tell you, there's a kind of a groupthink that goes on there, and it's very intentional. They try to make the companies all, I love Paul Graham, and I think he's done immensely valuable things, but he has a point of view about stuff, and you should understand that if you wind up in an incubator that is headed by somebody, it could be that or it could be something else, that has a point of view and an ideology, you're going to be shaped by that. And I would just suggest you go in, with your eyes open and learn about the cultures of these different places. It's like picking a college. It's actually amazing how many 18-year-olds pick colleges based on the most random criteria. I mean, I know it's hard when you're 18, but even so, I would say trying to find something that's a good match for who you are and what you do. I mean, historically, Y Combinator, it's changing a little bit, has been extraordinarily unfriendly to female entrepreneurs, and they've taken some heat about that, and it's maybe changing a little bit. What's that? Yeah. So he said, thank you for saying that. So, think of yourself as a consumer. Think of these things as schools or universities offering things. And if you're applying, try to find something that's a good, that's a good match.
Rob?
I guess I think, all of the, I'm not talking about the co-working places necessarily, but all of the incubator, accelerator, or whatever type of things. I mean, they all have fundamentally the same three components, and which is, they have, generally a group of mentors and people that come in and help. They have a Yoda, and they have some sort of like fundraising process that they put you through, right? I mean, and there's a lot of argument around the edges about my Yoda has, more
my Yoda
force.
is better than your Yoda.
The force is more with my Yoda than your Yoda, and all this kind of stuff. But at the end of the day, that seems to be the three components, and they do argue about the edges, but those are the things. I absolutely agree with Jeff that the most important thing is that you are in a room, sometimes all day long, sometimes once a week for a couple hours, but with your peers, where you get to know people that have the same sorts of problems that you do and are going through the same sorts of issues that you do and have the same sorts of founder kind of friction that you do, and having kind of, and my East Coast partners always complain, not complain, but they always look at me kind of weird when I start talking this way because I think they think it's a little too California, but there's a lot of kind of emotion and stress and everything involved with starting up these companies, and having people that are going through the same thing you are is actually really, and people that you can count on is super important. And it's why my office here in San Francisco, I've got exactly 2 people that make investments, and then 1 other person that is a first-round capital employee, and then I have 5,000 square feet. And the reason I have 5,000 square feet is because when I make an investment in an early-stage company, and it's like, 3 people and a dog, I say, come on in, and maybe not the dog, and why don't you hang out here with these other 5 companies that are hanging out here, and we see a lot of cross-pollination and a lot of relationships being built just among that. And we're not trying to be an incubator, we're not trying to say that it's anything like that, but we see the value of the relationships that get built and the support structures that get built and how that can really help these companies.
Hey Rob, as you know, we have dogs in our space.
I know you do.
So I think Mitch had a great analogy, which is think of them like colleges. I actually think of them like the new grad schools. And so there is a Harvard, there is a Yale, there's a Berkeley, there's the University of Phoenix. So you kind of want to be careful about where you end up. And I think what these really do is they point to the abject failure of MBA programs in teaching business or entrepreneurship at the early scale. So if, the people used to go to MBA programs and say, I'm going to go out and be an entrepreneur, and I think eventually we figured out that MBA had nothing to do with being an entrepreneur. And so now these combinators and incubators have sprung up and are essentially replacing the MBA program, except that instead of paying to go, you get paid to go, and you get to go create new jobs afterwards rather than have to go get a job with somebody else. And you have to go do original work and not derivative work. So I think they're very, very interested in that regard. But as various people here have said, choose wisely. And it's good to hear the Empire speaking up for the Rebel Alliance. Cats and dogs sleeping together.
So on building your team, you often have, like Jared, a solo entrepreneur. Any recommendations for solo entrepreneurs, how to build a team, advisors, value advisors, and sort of that process? And I'll pick on you, Jared, first.
Yeah, it's...
Because you had to fight the...
It's uphill, definitely. Jeff mentioned it was one of the things, sort of a knock against us, or a knock against me, was that it was I was the only guy on the team for quite a while. I think the most important thing in building your team is just making sure that you get people who are, as passionate and as dedicated to the idea and smart enough to, as passionate and dedicated to the idea as you are, and smart enough to, and have the right abilities to really carry it forward. it was a long time before I really tried to bring anyone on the team. And this was, it was an interesting decision that I'm not sure if I had it to do over again, whether I would do exactly the same thing or whether I would try to bring on somebody earlier. It's hard to say. But I think the calculation's a little bit different for everybody, and it depends on what you bring to the table personally in terms of what pieces of the business you can handle. Some people are just technical, some people are just business side, and so on. But I think in terms of what's important and what the process is like, really it's not that different from pitching investors. I think you're pitching another person on the market that you're attacking, the product you're creating, and your ability to make it happen. And the process is very similar. You have to convince them. And but actually going to something that both Mitch and Naval said earlier is just like when you're talking to investors, the answer is not to just sell harder, and it's not be even more crazily passionate about your idea that maybe just maybe no one wants to join you for a reason. Like keep. Someone said keep your eyes and ears open when you're in an incubator program or when you're thinking about an incubator program, and likewise when you're talking to investors and when you're talking to potential team members. Every single interaction you have is an opportunity to learn something, and if that's one of the biggest pieces of value to it, I think.
Mitch?
Yeah, slightly off topic, but really related. I think this is important. I think there's a lot of value in knowing when to stop and try something different. Partly because the Valley is very tolerant of failures where there's a lot of learning, and partly because the costs of starting things are a lot lower. And at critical junctures, whether it comes to raising money or you're a founder and you're trying to recruit other people, at a certain point, if you're getting enough signals that this isn't working, the strategic thing to do may be to say, well, maybe this idea isn't the right idea, or maybe this constellation isn't the right constellation. And having an ecosystem of friends, advisors, people you trust who can help you look at that is incredibly valuable. Because, for instance, we have wound up investing in at least 3 teams I can think of. They all came out of Y Combinator. I turned them all down the first time with a project that they actually did Y Combinator, and I thought they were good, but I thought that the idea they were working on was the wrong one. And I said, if you wind up doing something different, please come back and I'd like to talk to you again. And that is what happened in each of those 3 cases. And it was the second idea in one of the cases with a different team configuration. So I think you should be thinking about, it's just not a linear march of idea, team, founders, raise money. It can be much more iterative. And I think there's a lot of proof that some of these iterative startups actually only wind up getting funded and having their team on the second or third try of the founder within the same, so just please keep that in mind.
Yeah. Maybe we'll switch a little bit. Any thoughts on how much money an entrepreneur should be raising for that initial seed round? And I'll start with you, Naval.
Whatever you can get, but that's a glib answer. It's highly contextual. It depends on your stage. When you go to an incubator, in theory, you're raising money from them, but you're really getting a very small amount of capital, and it's amazing how much progress people can make with that. So I see companies that start out in an incubator, they have $25,000 capital, and they make tremendous progress in 3 months. And then I put in $250,000 or $500,000. I watched them sit there for 6 months, and I wonder what just happened. My money just slowed everything down. So the real answer is that seed rounds these days are somewhere between $250,000 to $1 million. The closer you get to the $1 million mark, the more people you price out, the harder it gets. There are some companies that do $1.5 million. There are some that do $41 million, in which should be a seed round. But it's all over the place. $250,000 to $1 million is a good range.
Jeff?
So the question I'd like to ask is, what is the next meaningful set of milestones that you will need to hit in order to raise your next round, your Series A, your $3 to $5 million round? And typically you work backwards from there. And you say, well, I need 2 engineers or 2 more engineers and this and that and the other, and roughly takes 18 months of runway to get there. And so you sort of do some kind of a back of a napkin calculation, and you end up between $500,000 and $1 million. So I would say most of the things we've done over the past 6 months were sort of in that ballpark, 700, 750, and so on and so forth. And you try and figure out, whether that you get there sort of comfortably or not. And there's never sort of comfort in the seed round, because this is when the cost of money will be the highest, because by definition your valuation will be the lowest. And so you need to figure out, what feels a little bit sandbag but not too much. And my own sort of personal math is I want to see 18 months of runway, because typically it takes 12 to 15 months to build the product. And even in this environment, you want to see, at least 3 months for the fundraising.
Rob?
Yeah, I'll try to thread the needle here a little bit. I mean, traditionally, we've done exactly what Jeff has done, is really do a milestone-based plan and figure out how much capital is going to get there. And then because you're always too optimistic, then I'm going to add like a pretty significant, like 50%, number to that, just because I know that, shit happens, right? Or sometimes shit doesn't happen in Naval's case, right? So as an aside, I have had people that have raised money and then they're like, I'm going to go take a vacation. I'm like, what? Seriously? This was your goal, to raise money? But right now, we're in a different time than we've been in the past few years, right? And so I'm seeing seed rounds that are being raised at valuations that would have been, or kind of A rounds that are raised at valuations that would have been the valuation for a company that really executed and was getting for their B round in 2009. Right? And so when you raise money at a valuation, that's a bar that you're going to have to continue to get over. And so you have to think about, okay, if I'm raising money, the next time I'm raising money, even if I kick ass, if I'm raising money in 2009, what is the valuation going to be? And if the valuation's not going to be that great and you're still going to be kind of ailing, then I would lean towards what Naval said, which is, if you can raise at a high valuation, raise as much freaking money as you can, because you really don't want to have to go out and you want to be able to decide when you go out and raise money next, and not have it based and not be stuck in a trough, in an exogenous event trough that you didn't create but ends up screwing you.
Here's a dissenting view to that, and I don't think there is a right answer, because I've given people that advice. But it's like the 3 bears. The porridge can be too cold or it can be too hot. And I have seen a number of failure cases where companies have raised too much money. And it makes it, they may not go on vacation, but it dilutes the sense of urgency. And I think a sense of urgency, it needs to be really high, but not too high. And the prospect of running out of money, like the prospect of being hanged in the morning, concentrates the mind wonderfully. So there are trade-offs, because I think having a kind of a cushion against these exogenous events, actually, experience has shown that that's a smart idea. But honestly, we've walked away from deals because they said, you just have too much money here and the incentives are going to be misaligned. And so the key thing comes back to milestones, which have been mentioned by a couple of people, to have a theory about what you're actually trying to do in this next stage. Is it about validating the sort of the product hypothesis? Is it about demonstrating that you know how to scale the thing? Is it about both of those? Is it something else? The more clarity there is about what you must do in this next stage, and by the way, if it's not something you must do, you shouldn't be doing it at all. That is going to tell you roughly how many people you need to have and roughly how long it should take. And yes, these rules of thumb of 250K to $1 million are, that has been the case. But I like to, the more kind of bottom up, the more clarity there is about, here's where we are, here's what we've learned, here are the challenges ahead of us. I don't know how we're going to solve these, but the plan is to go and construct over 6 months or 12 months or 18 months an effort to go and figure out A, B, and C, and we're going to be relentlessly focused on that. And if you have a good idea and a strong team and credibility around that, then the numbers are what the numbers are. And that's why there's a lot of variation in the actual amounts and why these rules of thumb are pretty rough.
Yeah, I would support Mitch's point. I've been on boards with VCs, and a lot of times you'll see people on BlackBerries and iPads. You're doing great, keep going, good presentation, great progress. And then when you're within 6 to 9 months of running out of cash, everybody wakes up. It's like, well, where's the business model? Are we really getting where we want to? Things suddenly get really, really tough. So there's nothing like knowing you're going to be hanged in 6 months to sort of focus and crystallize the mind. And the corollary to that is that you can waste a lot of time in a startup, in an idea, in a market that's going nowhere. And you're a prisoner to the people you recruited and you raised money from. So if it's not working, having less cash is a virtue because you can get it over with faster. The value of your failure, and you can go start the next
Well,
thing.
less cash and fewer people.
Yeah,
Easier to turn.
absolutely.
So, Jared, talk about how much you raised and where you ended up.
Yeah, we actually originally, it's interesting because I think we wound up starting out looking to raise a smaller amount, and we wound up getting oversubscribed. We were originally going to raise 500, and then, as we were trying to get some investors involved that we really wanted to work with, there wasn't room in that 500, so we had to expand it a little bit. And I think that we definitely turned away money that we could have had because, as they've said, you don't want to get lazy. You don't want to start thinking, oh, I've got all this money in the bank. And you start doing stuff like buying really swank office furniture and going out and throwing big launch parties and doing a lot of stuff that doesn't necessarily really drive your business. And I think you want to raise as small amount as you can actually get away with, I think. But that said, you need to have a really good understanding of how much that actually is, and it's more than you think. So I'm, looking back, I think it was good in the end that we wound up raising, getting oversubscribed and raising 750 instead of 500. Not because we're going to be in any danger of running out of runway at the end of that, but because having the little bit of the extra cushion is nice if some terrible thing happens out there that we couldn't control or predict. That makes hitting those milestones a lot harder than we anticipated. I agree that you really want to think about what you're trying to accomplish with this round of funding, and then work backwards from that to how much is it going to cost, and then you round that figure up a little bit because it costs more than you think.
So switching the subject a little bit, what do you see as valuations and the importance of a syndicate? There's two questions in there, and let you guys think of which one you want to answer. And I'll start with you, Rob.
Valuations are what the market will bear, right? That's just.
So what would you, for a social media type company today, an entrepreneur, what do you?
They range. I'm literally still, I'm still seeing things at valuations that were similar to what they were in 2009, and I'm seeing things that were, we've all seen things in the market that are, raising. Hey, we have 4 guys with an idea. Let's go out and raise $41 million, right? So yeah, there's somewhere in that range, between 2 and 100 million, right? So, but in terms of the syndicate, I think that, I see 2 different things going on right now. I see there's one kind of theory that's going around. I've seen a lot of rounds that come together where there's, you say someone's raising $1 million, $1.5 million, $2 million, and they've got a bunch of people in there, and they're everything from Sand Hill Road venture funds to, Ashton Kutcher, right? And they're all in the syndicate, and no one has more than, say, 200,000. And so, and the theory behind this is someone's taught this founder, you want to make sure no one has control over your company. And I totally get that, right? And so that's what they do. They make sure that no one has control over the company. The challenge is they're not going to have, when the economy inverts, and it always does, the venture kind of economy inverts, and it always does, I also don't know who's going to kind of stand by that person, right, when things aren't working as well. And who's the person that's the lead and is going to raise their hand and say, I'm going to really work hard to figure out how to help this company. And so that's the challenge I see with those. But I think in general, you want to find people that you can feel that you can work with and you think can help you. And sometimes helping you means they're a movie star and they have a lot of visibility and they can get you some notice in a market that and you know, people laugh, but for some companies that is the right thing. For other companies, it's not, right? And but having people, you know, knowing what everybody's job is in the syndicate and making sure they're signed up for that job, and some people may not have a job, but some people do have a job, I think is the important thing that you need to think about when you're putting together your syndicate and who should be in there, because you want to know who's going to help you raise your next round, who's going to help you with strategy, who's going to help you with business development, who's going to help you build your team. And because that's what you're looking for from all of those people. And if everybody in your syndicate, you know, it doesn't, you know, isn't able to do the job that you want them to do, then you have the wrong person in that syndicate.
And just a follow-up on sort of one of the values that you add is you have this office space. Do you charge entrepreneurs for that, or is that, so in your valuation, that's just part of the deal?
Well, I mean, I don't even think of it as, I mean, it's just something we do. I don't think of it as necessarily a, you know, there's nothing written into a term sheet that says, and there's 4 cubes in the southwest corner of my building facing the Bay Bridge. You know, I mean, there's not that. It's there if people want to use it, right? And that's the more the way I think about it.
Naval?
Yeah, to answer your question, the valuation for your social media startup without traction right now is 0. And that's basically what you would get funded at, because the market has just moved past that. If you're doing something in social media, you have to have traction, and the traction determines what your valuation would be. And what's going on is a highly, highly bifurcated market. It's a power law distribution to the outcomes. The market for investment has recognized that, so there's a power law distribution to the investment market. So you're going to set your price at roughly the average, which is all over the place. It's from maybe a 2 million pre up to an 8 or a 10 million pre, probably averaging somewhere around a 4. So you're going to set your price at the average, and you will be wrong. It will either be too high, it should really be 0, or it will be too low. You're on the edge of the curve that can get funded, in which case you could have gone all the way up. And I just think there's almost no way to tell. I have the largest database in the last year of private company pricing on the planet, and it's irrelevant, because there is no mean. If those of you who kind of know your kurtosis distributions understand, when you have this kind of an outcome, you cannot actually calculate a mathematical mean. It's a meaningless concept.
Jeff?
So what Rob explained is really critical. I see the initial syndicate of investors as sort of the infrastructure of the startup, and who you bring. And you know, you might be a repeat team, and you know exactly what you have to do, and you just need money. Fine, you're actually not in this room. But for the rest of you, there is actual sort of real value add that Naval, that the Mitch, that the Rob are adding on all the different components of execution that you will actually have to go through over the next 18 months with your seed financing. And yeah, it's cool to have a lot of followers on Twitter, but you know, having helped build tens or hundreds of startups doesn't always tell you what's right, but tells you, you know, you have pretty much a bunch of battle scars, and you know what sort of doesn't work. And we can sort of really help you with that. So I would really pay a great deal of attention at the lead and who's going to be working with you, putting the rest of the syndicate together, and who's going to be, you know, the first person you call whenever the shit hits the fan. And it always does.
Mitch?
So I think it's helpful to recognize we're in, as far as I'm concerned, a period of structural uncertainty. You have, to me, 3 very different groups of people all coming into these syndicates. You have folks who are up here who are either run funds, professional investors, or very experienced angels who are going to help raise the next round and have, you know, sort of been there and done that. On either side of that group, you have inexperienced angels who write checks because they can, and you have VCs who are Sand Hill Road, you know, VCs who are trying to figure out what their future is, because the single biggest dynamic is that the deals that used to go directly to them
no longer do that. They all get done at the seed level. So this is in consumer IT and mobile. They are scrambling to reinvent themselves. And so you have heterogeneity among potential investors. There's heterogeneity among the people listed on, on Angel List as investors who bring different skill sets, and you've heard some good comments about that. But the reason I say it's a period of structural uncertainty is I don't think anybody on the planet knows what's going to happen with these crazy $2 million deals. We're all seeing that have 3 Sand Hill Road guys at, $400K and a couple of micro funds and a bunch of individual angels. What's going to happen? Are they going to be able to raise an A? Who's going to lead it? How are the dynamics going to play out between all the people who are in the syndicate? And doing a startup is all about managing uncertainty and managing risk and figuring out how, with very scarce resources, you can reduce the multiple dimensions of uncertainty to certainty to wind up with a functioning business. So while it's exciting on the one hand that you've got more options and more different pools of money to draw from, that greater uncertainty and the fact that you can't rely on any historical patterns with a high degree of confidence about how you're going to build the group of people that you work with in the investing ecosystem over the course of the company, that's actually an adverse kind of condition. I mean, I think we can all live with it, but let's not fool ourselves that I expect that things are going to blow up in ways that nobody really sees right now, and there'll be some sets of companies that can't get funded. There's just going to be great pain and unhappiness, and I'm on the lookout for trying to see what the early signs of the new patterns of pain and unhappiness are. And I actually want to ask my fellow panelists if they're seeing anything that's beginning to emerge. The thing that I focus on is these crazy $2 million rounds with, that's just like a mad scramble. And last thing, which is that understand, if you don't already, that if you take an investment from a Sand Hill Road venture capital firm of, a few $100,000, that's walking around money for these guys. Not Rob's fund is structured differently, and he can speak to himself. I'm talking about the Sand Hill Road is like Silicon Valley. It's a state of mind, not just a geographical place. But it's walking around money. They're getting what people call option value. The only interest that they have is if they can invest a lot of money in you if they want to, because their funds are set up that they're economically viable only if they can put millions of dollars to work. And there's an inherent lack of alignment, risk of lack of alignment between you and those venture capitalists. And as I said, it's unclear to me how all that's going to play out.
Jeff?
So piggybacking on Mitch, so you have those 3 camps. The new angel, and the new angel is someone who's made money selling his companies, or selling shares on secondary markets, and wants to help and wants to support. That's awesome. They have no idea as to what the pricing of a startup is. And so they will say, 10 pre? Sure, whatever. The Silicon Valley VC, as Mitch explained, doesn't really care about the price at which he's going to buy $100,000 worth of shares, because it's nothing to them. And so once again, 10 pre, sure. And then you go to Rob, and Rob has seen thousands and thousands of... I'm not picking on you yet.
Rob's the cheap bastard.
I was going to claim that. Stop that. Shit.
I'm just sitting here.
And so Rob has seen thousands... I'm going to say something nice for once, so shut the fuck up. So Rob has seen thousands and thousands, we work together a lot, so we can do that. Has seen thousands of deals and has imperfect market data, but more market data than you have. And he's basically going to tell you, look, based on the team, the opportunity, what you've done, so on and so forth, I think that a fair price in this environment is for pre. 10, 10, 4. What'd you do? The right answer is you go with Rob, and Rob figures out, and okay, it's my interest to get you at the right price as well, but Rob will help you get there. Yeah, give me some. Will help you get there because he knows that you can then ramp. then you can ramp into your valuation and you can actually produce something that will get you funded at 15 or 20 or more for the next round. Whereas if you get in at 10 pre, Rob will say, best of luck, most likely, because these days sometimes you wonder. Because 10 pre is just not sustainable. And all these people who you've gotten in at 10 pre sort of are interested, but they don't care. They're not really passionate about what you're doing. They're like helping on one side, or they have option value on the other. And when the proverbial shit hits the fan, they're going to go, whoa, too bad. Yeah. And worse, if they feel that they actually overpaid because you have problems, they will say, given the price I paid, fuck that. And I've actually started seeing that, what I call those orphans, where they manage to get investors to pay a high price for their company. They're not really executing well. They're sort of, lost. And when they call their investors, well, look, I really don't have that much time these days. Why? Because I overpaid for something and it's a small investment. Who cares? And you really don't want to be an orphan.
Jared, why don't you talk about your round and your syndicate and valuation maybe process?
Yeah, I think definitely one of the things that comes out of what everyone has said is that the composition of who's in the syndicate is really, really important. Frankly, I think that's a lot more important than the valuation that you wind up with. It was one of the things that I'm most happy with about our round at Breezy. Larry, did you want me to talk about like who's in the syndicate, or
just your percentages? Because you were oversubscribed, so you did think about your syndicate a little bit, and
ultimately, it came down to sort of who did we want to work with, and Rich Wong, who led the round at XL, I remember telling me, early in the process, said, I mean, look, at this point, we can give you the rest of the money if you want. We'll be happy to do that, but he agreed with me that it made more sense to try to bring in a syndicate of people who had expertise in the stuff that we were trying to do. So we're a mobile company, a platform really kind of targeting enterprise. And so we wanted to bring in people who had mobile experience, who had enterprise experience, and who would have the influence in being able to help us build teams around these things and drive business development. And so that's, I think, where you want to. First of all, if you're in the position of deciding who's in your round, it's a good problem to have, right? Because many startups wind up in a position where we need to raise 500K and we're struggling to pull together the last 100 or something. So when you find yourself having to choose between this guy who's going to offer you this money at this valuation or this other choice over here, it's a good problem to have. But I think that it's more important to go with this sort of what Jeff is suggesting. Don't worry as much about trying to just get to shoot for a high valuation as you do about. You should worry more about trying to build the team. You should select your investors the way that you select your employees.
I'm going to try to open it up to questions as soon as I can. So I have two last questions, and then we'll open it up. And one is, does it matter to you the form of investment, whether it's a convertible note or a Series seed? And the second is, what do you have an opinion about strategic investors at the seed stage? Because you're seeing more and more strategics as potential early investors now.
What do you call strategic?
An investor who could be a partner of the company that would do business with that company. So that would be a strategic investor.
So I'd rather, especially at the very beginning, I would really try and have investors invest and partners partner, and not have partners invest, because it's kind of tricky, and it's, what we try to do is we try and build the company, and so if the partner starts having a different set of incentives, it can really sort of screw the dynamic around. And in my personal sort of approach, Series C is when you start looking at bringing strategic investors. There's always exceptions and differences, but later, once you're set up, once you have a strong syndicate of investors and so on, so you can think about bring strategics in. And there's other ways to incentivize a partner on your success rather than bring them in as an investor. In terms of form, if I look at the 14 deals we've done in our new fund, 2 are capped convertible notes, 12 are equity.
Series C. Series A?
Series Seed, Series A. I mean, Series Seed, it's kind of the same docs. Series Seed tends to be more like below $1 million, $1.5 million. Series A is like $3 million and up.
Yeah. Naval?
Yeah, so I think that about 2 years ago, convertible notes became really popular, both because you could sort of float the price, and there was this perception that it was simpler and easier to do. And the various incubators and combinators started pushing that as a standard, almost like a unionization tactic with their startups. And actually, I think it has now become embedded in the system in such a way that's doing a disservice to the startups. It is harder to raise money on a convertible note because sophisticated investors don't want to invest in a convertible note. And there are many good reasons for that. The most basic one is there's a qualified small business stock exemption right now in place. You invest in a qualified startup, and if you hold it for 5 years, you don't pay federal taxes on the gains. And that clock only starts ticking once you've converted to equity. And if it's not before the end of the year, you miss out. Another example is the capital gains clock doesn't start until you turn into equity. And there are more investor protections, your incentives are a little better aligned, and so on. So I think as a startup these days, if you're doing a convertible note, you're probably doing it because you read it somewhere, you're coming out of one of the incubators where they hand you that. It's a simpler document. And you might save a little bit on legal fees, but I think it actually lowers the market of investors that are available to you.
Mitch?
Yeah, I'm also seeing a trend away from convertible notes. The thing to keep in mind is there's a saying which is never mistake a clear view for a short distance. I have a modification of that to apply to seed stage startups, which is never confuse a fast start for a short course. So because it is, you need less money, you can get going more quickly, the knowledge of how to do startups is out there. And in that context, doing a convertible note, I mean, it seems like totally the right thing to do. But in fact, what we're seeing is getting off to a fast start is great, but building successful companies is a no less difficult, long-term, multi-stage, fraught with problems, exciting, passionate journey, just the way it was 30 years ago when I was starting. I mean, the landscape is somewhat different, but the fundamentals aren't different. And the disadvantages of convertible notes in that context are substantial because by pushing off issues of valuation and by really not clarifying the relationship between the investors and the company, it's simple to get started, but it can accumulate a karmic debt that shows up. And so I'm kind of agnostic now. And in any event, I can't really think of a single deal where we didn't do it because the form of the deal wasn't right. It's been close a couple of times, but I don't think investors should be, rigidly ideological about it.
I will respectfully disagree. You will not get me in an uncapped note.
Well, so you have LPs. So
Yes.
you have a different,
Yes,
I mean, your mileage may vary.
Rob?
I pretty much echo what everybody's saying here in terms of what we prefer. We prefer equity, but we have done notes and we will do notes, and sometimes that's just what the deal is, right? And if you want to be involved with the company and they're doing a note, then you're going to invest in the note. I think the one thing that I haven't heard people bring up and that is important to say is that the chances are if your company is successful you are going to at some point have to raise an equity round, and at that point you're going to get these things that are called terms, right? And if you take terms from anybody on this up here, you're going to get what we call very light terms, right? There's not going to be anything that the lawyers have. It's nothing over lawyered or these crazy ass preferred structures and all the rest of it. It's going to be very, very simple. And one of the things that I've learned is over the course of doing your seed round and your A round and your B round, your C round, and so on, is terms don't ever get better, right? So no one has a participating preferred in Series A, and then they don't do that in Series B, right? And so when you start out, with us anyway, or any of these folks up here, and you raise an equity round, you're starting off with a set of terms that you know you can live with and that everybody can live with moving forward. It's not saying they won't get worse, they could get worse, but they're never going to get better than that. And so starting up with something that's really good is important. And then in terms of strategic investors and seed rounds, I mean, I don't know. I think strategic investors for the most part are like it's like jumbo shrimp, right? I mean, you're strategic or you're an investor, right? And so a strategic investor is like, well, you know, what does that mean? And having run a corporate fund early in my career, I know exactly what that means. That means that, you know, dude in business unit over here is coming to me and saying, hey, I've got this partner that's going out of business, but I need them to ship my next product. So can I move them off of my P&L onto your balance sheet by you investing in them? And if you don't, I'm going to go tell my mom, right? And it's like, fuck, dude, you know? And so there's all these games that are going on in these corporations that you do. And the other thing is, you know, going back to terms, you know, you're going to be doing this set of terms, and then at the end of it, you know, corporate dude's going to come in and say, oh, by the way, I want to right of first refusal. And you're like, what? You know, you never said anything. You know, that's out of the question. That's not going to happen. And so it just like totally messes up the whole kind of cadence and structure of getting, especially these early rounds, closed. Later on, or, you know, because the last thing one of these guys wants is to invest in a company that's going to be acquired by a competitor. So later on, when you're like doing hundreds of millions of revenue and someone wants to give you hundreds of millions of dollars, and in exchange for that, they're going to turn your business from a $1 billion business into a $3 billion business, sure, take the strategic money because it's probably strategic for you. But early on, stay that fuck away. Just don't take those people's money.
Jared?
Yeah, I did a lot of thinking about debt versus equity, and certainly there's a lot that's, you know, written about it. I really think it depends on the particular situation. As people have pointed out, certainly convertible notes took off in popularity over the last couple of years, and it was, you know, there was a perception, I think, among entrepreneurs that convertible notes are what's favorable for the entrepreneur, and equity docs are more favorable for investors, so whenever possible, you should always argue for the convertible note. I don't think that's true, particularly because, you know, as Jeff said, he's not going to do a note that doesn't have a cap in it. Most people won't, and from an economic standpoint, in many cases, I think, and specifically in Breezy's case, I think we would have actually been slightly better off economically had we just done the whole deal on an equity basis rather than a debt basis. There are other considerations that play into how you decide. And really, in our case, it boiled down to, you know, you were talking about the terms that you're going to get and how the terms that you get today are the best, whatever you agree to in your equity docs today, whatever you do next isn't going to be any better than this. And I didn't want to have the discussion at the stage of traction and proof and everything else that we had at the time when I was raising a couple of months ago. I didn't want to have a discussion about terms because I thought we didn't have really a strong enough negotiating position to get terms that I would really be happy with in terms of, you know, control rights and all of that sort of stuff in terms of how the company is going to be run moving forward. And so I deliberately decided to take equity, to issue debt rather than take equity so that we could put off the discussion of what the terms are, just like we put off the discussion of the valuation, except for the fact that, you know, we wound up capping the valuation, so we had to have that discussion now anyway. But so I really think it is different in every case, and you have to be really thoughtful about what goals you're trying to accomplish with the particular round that you're raising. There's not a one-size-fits-all solution.
Mitch, any last comments before? Okay, so I'm trying to leave a fair amount of time for questions. Gentleman up front.
Go to the mic.
Yeah, there's a mic right there.
I don't need a mic. Thanks very much. I really appreciate the thought. I'm interested in how much time you sort of budget and actually have to spend with investors, because with companies. So, you know, I want the help with the outreach and the networking. Do I get, you know, what it needs? I mean, obviously, I think we do 40 hours a week. Do I get, you know, 5 hours a week for the year? How much time do you actually spend with people?
So it really depends on whether you're sort of in crunch time for a very specific reason, whether it's product launch, whether it's fundraising, whether it's major design phase. So I don't really sort of budget my time. If I was looking at the time I spent across the portfolio, I would say, that could be half an hour, a week. Some of my CEOs call me when they need me. So what you do with the people you invest in is early on you establish what the protocol is, whether they want a regular meeting or phone call, or whether it's like, hey, just shoot me an email or call me whenever you need me. And there's, as I've said many times, there's no pride in our business in the sense that we're here to help you, and so whatever you need us to do, we'll do. And we'll figure out whether it's us or someone in our network who's the best equipped to deliver the sort of help that you need. But I would sort of make it clear, as we talked about the formation of a syndicate, who has which role amongst the different syndicate members, so that there's clarity as to whose job it is to actually do something. And typically, if you're the lead and you put the syndicate together, the onus is on you to sort of be much more active.
Mitch?
So we're actually thinking about creating a social term sheet. We're just still kicking the idea around, which really tries to explain in advance what it is that we do and the kind of value that we can add, but also sets out a set of, or it asks for a set of commitments on the part of the team. This would be like completely non-standard, and so it's right now a thought exercise. Part of the reason that's driving that is we're focusing increasingly, as I mentioned early on high social impact companies in education, looking at healthcare, not just, but with more concentration there, because the outcomes we're after are both financial, but also the creation of social value. But as we've been doing this, it's occurred to us, this is kind of a two-way sort of street. It's fair for founders to know what they're going to get, not just from any one of their investors, but really from the syndicate, because it's a kind of divide and conquer, a distributed effort. Some companies I'm very involved with, and others, one of the other people that I co-invested with is doing more of the heavy lifting. And as Jeff said, it's good to have a protocol, meaning is there a monthly investor update that goes out? And because we've done a relatively large number of investments, I'm actually thinking for things to be in balance, we not only need to be clear about how much and what kind of time we spend, but really ask entrepreneurs, particularly first-time entrepreneurs, to think about what they're signing up for. Like, what does a good investor update actually consist of? And I'm increasingly getting to the point where someone is doing any kind of consumer play, if they're not prepared from day one to have a useful metrics dashboard as part of what they do in their offering, I'm not so interested in doing it. And so trying to wrap all this into a social kind of term sheet that's not binding, but that sets out more of the general framework of here's how we're going to work together, it's a very attractive idea. We're thinking about it.
Next question? Oh, sorry, you lined up. Great. Go ahead.
To turn the tables a bit, I'm having kind of, to be honest, I'm having kind of the same issue that you have with probably a lot of the entrepreneurs you see, where you see 100 group messaging pitches. I'm raising capital, talk to a bunch of venture capitalists, angels, et cetera. I'm not seeing a lot to differentiate you guys. I'd be curious, if you had to give your elevator pitch, your 30 seconds, I just came up with the next Google. Let's say you all want to invest with me. Terms are identical. If you wouldn't mind, each of you, why to go with you in 30 seconds or less?
Well, I think well, we're laughing, but it's actually a very fair question. And that's why I would say, well, I will give you the pitch about the support, the help, the portfolio we've built, or whatever. We will say, just go talk to entrepreneurs, and they will tell you the support we've been able to deploy over the years to help them build their company. And that's really where the action is, because we can tell you all the bullshit we want. At the end of the day, they will tell you whether we're here in good times and in bad times. Because when you're just a high flyer, it's easy to be an investor, to be honest. It's really when it's tough and the company is about to run out of money. And by the way, here's the scoop. Most of the successful companies always came very close from running out of money at least once or twice, right? And so when your investors are there to support you, and it's not always by just putting more money, but how they actually muscle in to support that situation is really where the sort of feedback you want to get.
Rob?
Go ahead.
Yeah, so I mean, I've got the same thing. I've got a website with all sorts of marketing information about how great we are and all the stuff that we provide and everything else, and I can walk you through each of those pieces. But the fundamental thing that I do, and I encourage every entrepreneur to do with every investor that they're thinking about working with, is, I will tell you, go through our portfolio, there's a lot of companies, and pick out any company you want, any set of companies you want, all of the companies if you want. I will make as many introductions to any company in my portfolio, and you can have a conversation with them and talk about what it's been like to work with First Round. And that, I think, is going to be the most telling thing, because these guys, entrepreneurs don't lie to entrepreneurs, right? I mean, you get your best deal flow from entrepreneurs, you get your best recommendations from entrepreneurs, and entrepreneurs will, I hear entrepreneurs all the time say, I will never ever send another person to that firm or that person or whatever because whatever, they were a dick, right? And so, and that's something that you need to know, but it's important, everybody works with people differently, right? And so it's important for you to understand who it is that you're working with and why it's a good, fit among the many vectors that you think about fit. And the way you're going to do that is by talking to people that have worked with those people before.
Ditto.
So I was going to ask a point on that. Why are there no metrics like every other investment has for this space? I know it's still there's still a group of people who kind of are the people who do it, but I'm a data guy. Why every other investment has metrics that are open, everybody knows what they are, but this industry really doesn't. There's IRR for the VC guys, but there's no other metrics. Not for teams, not for investors, not for leads, not for partners, not for institutional. Why is that? Besides people wanting to have IP unfair advantage.
Yeah, I'll answer that. Actually, it's structural. So, with AngelList, we gather a lot of metrics, but it's by no means a complete snapshot. But I've often thought about that, which is why does no one publish their valuation? And the reason is because the valuation is a zero-sum game negotiation between the two parties, and by definition, someone's always wrong. Someone underpaid or someone overpaid. Yeah. And so because either the company is worth more than you paid for it, or it's worth less, so someone looks wrong either way. So there's a structural bias towards not revealing that information. That's just kind of the underlying game theory reason. There are many other good reasons.
Yeah. Because the problem is, I deal with like screening for a group, and we're looking to syndicate and do a lot of interesting stuff, and people are approaching, but I'm a data guy. If I can't get real metrics besides because what you're talking about is marketing and anecdotal information. And that's not what data-driven decision-making is supposed to be. I mean...
Yeah, but even if you knew who had the best returns, how would that correlate with their cause and effect, right? So cause and effect and correlation are two...
You could do a calculation of their partner space, their unit base.
Let's go to the next question.
Next question.
Thank you so much.
So question mostly for Naval. My situation, I create a software tool with traction in the thousands, have some revenue, have some high-profile customers like the LA Times, and we're also 3 years old. So are we still a good candidate for AngelList?
I'd have to look at it in more detail. It's, unfortunately, it's not a science yet, and I think that was some of the complaints of the previous questioners. It's an art, so I'd have to look at it. Honestly, of the pitches that we get, 95% we don't even send out. And that's because we don't want to waste their time or the investors' time because it's not ready, and we'll be upfront about it. And we're being more upfront about it. We actually have a recent policy in place where we're sending explicit turndowns as quickly as possible.
So is that an invite?
I'm sorry?
Is that an invite?
No, I mean, you're welcome to come in and talk to me or send me an email or fill out the brief pitch and just make it visible to me or whatever you want to do. And I'll get back to you. But it's really hard to answer here.
Thanks.
Hi, I'm Roop, and I run an online advertising company called Edgevertise. This question is primarily for Naval, but any of you can feel free to jump in. There is a lot of talk, Naval, around how easy it is for startups now and how the bar has been set higher and so on. But the more I look at the space, and I've been running this company for about 3 years out of Australia and India, and I'm just setting up here in the Valley. The more I look at it, it is easy if you're building an iPhone app where you're telling your friends where you had your last beer. And I get that. But I'm building a business. I'm building a business that has a business model from day dot. And I have found it ridiculously hard. I don't know about the other entrepreneurs in the room here, but building a product, building a company, building a team, convincing people to part with $500,000 is bloody hard. And then getting people to try your product and of course start paying money, which is what we've just about started doing, is also ridiculously hard. So I find it quite amazing when I talk to investors and I talk to potential partners that work with this, that seem to have this relative cockiness about how easy the market seems to be, or how easy it's supposed to be for the entrepreneur. I think it's anything but.
Yeah, it's a highly, everyone has very different experiences. Like I said, it's sort of a bifurcated outcome. Either you're very fundable or you're not. I don't know much about your business, and I give you full respect for having built a real product that people are paying money for. My guess is the reason you're having a hard time raising money, it's just a pure guess in a stage in front of 500 people, a bunch of cameras, with no information. My guess is because you're building a very linear business where you get up in the morning, you move the ball forward, you go to bed, the ball is moved a little forward. And this is a lottery ticket type of marketplace, especially in the investment side in Silicon Valley. So the investors are looking for things that have an opportunity to be nonlinear. So just by having shown linearity over 3 years, you've just selected out most of the classic Silicon Valley investors. There is a group of investors who invest in the kind of thing that you're doing. They're just a different set. They're a little harder to reach. They're not as high profile, and they don't get up on stage that much. So.
We launched only earlier this year, so we spent much of our time building a product. So maybe not so linear.
Happy to follow up
anyway,
later.
Yeah, that's okay. Thank you.
Okay. I guess we'll have one more question, and then we'll thank our panelists.
Hi, my name is Jed, and I'm actually in the Founder Institute right now. The Founder Institute requires us to issue warrants, and my question is, how often do you all as investors see warrants? How do you deal with them? And maybe a question specifically for Jared, what was your experience raising money and how the warrant was handled?
The warrant is just, it's just like an option, basically. It's just a way of giving the Institute, it's what you pay for being in the program, basically. I mean, there's a little bit of tuition and stuff if you raise funding, but that's really where the upside of the program, that's really where the program hopes to make its money back, is by taking, its piece of that warrant pool. I wouldn't say there was any particular, experience around it. It was just something that, it was part of the requirement for going through the program. And to me, I think it was absolutely, the program was worth it. Even if, as people may or may not know, the Founder Institute, every company that graduates puts, I think it's warrants for, 3.5% into this pool that is then split amongst the Institute and the mentors who participate in the program, and then all the other people that are in your graduating class. So you get some chance to share in other people's upside. There's a little, there's some of that, but frankly, even if it had been a straight cost for us, I think it would have been worth it. So it never came up in discussions with investors. I mean, people were, aware of it. I think maybe we mentioned it, but it was never an issue that anyone was really worried about. I mean, it comes out of, that would come out of, of my, yeah, exactly, the pre-money in my position rather than the investors anyway, so.
I would say as long, we understand that the incubators have real costs and have to have a cost of opportunity, and therefore they have to make some money at some point. So as long as it's reasonable,
yeah.
3.5%, 6%, whatever, and there's no constraint on the future financing of the company, like we get to say who invests, or we get to keep a pro rata or whatever. I don't think it's going to be an issue.
Well, I want to thank our esteemed guests for coming here this morning, and thank everybody for making it out. Thank you so much.
Thank you.